Hi, good morning everybody. Welcome to Invest 360, the first and the largest regional market outlook event of 2021. I'm Ethan, COO of Investing Note, and today we have two special guests joining us today. Right? First, we have Mr. Song Seng Woon, who is the director and economist at CIMB Private Bank. Right? Next, we have Mr. Kenny Low, independent financial advisor and REIT specialist. And you've probably seen them both somewhere on TV, radio, and at seminars, right? So let's dive down into the topic, right? Right. 2020, of course, has been challenging year for basically every one of us, right? So if you're talking about economics, I think a lot of countries have suffered, even negative growth, except for China. So, Mr. Song, I'd like to ask you, as an economist, can you give us a quick recap of what Singapore, Malaysia, and Hong Kong economies have fared back in 2020 last year?
Well, I suppose we can just use the IMF description of 2020 being a lockdown recession year because of the pandemic. So now, obviously, we're trying to emerge from that, and essentially, it's still a very uneven recovery path, even as we move forward, despite the hopes of vaccines, etc.
Thank you, Mr. Song, for sharing. So let's move on to the stock markets. Kenny, what do you think?
Yeah, different.
Yeah. 2020 has been a very fantastic year, and if the investor really take action, right? If the another camp, the investor, they fear all the recession and also the so COVID-19, and they never take any action in 2020, probably they'll miss out once in a lifetime that kind of market rally. I just give you some statistics how the performance on the market itself, right? Just based on the index, actually S&P 500 go up by 70%, 70 from the bottom in March. Okay, that's really we seldom see this kind of performance. And at the present moment, S&P 500 has already broken a new high, and actually at the 10% compared to the pre-COVID-19 level. Nasdaq itself has went up about 90% from the bottom in March, and also at the present moment breaking a new high, 33% compared to the pre-COVID-19 level. STI, we know that STI has been moving sideways for so many years. Okay, it also has rallied for about 30% from the bottom in March. But STI is not really back to the pre-COVID-19, and they only recently rallied from light in November 2020, powered by the DBS Bank. All right, and for those active managed fund, 2020 performance, technology sector about 80 to 160%.
Wow.
Okay, China equity 20 to 30%, gold minus 20 to 40%. So you can see that
different planet. So what recession?
Yeah, what recession, right?
Yeah.
So these are the I summarized that there are three important lessons for the investor to learn. Okay, probably that will be the important key takes away, right? So it's very important that to always remember what Warren Buffett said: be greedy when everybody is fearful. So if you want to invest, maybe you hope the next super crisis come. And also, stock market is not an economy, right? I joke with Seng Woon, right? Stock market is in one planet, and economy is on another planet.
Yes.
So if you want to make your life more enjoyable during this COVID-19, you need to have one on both planet, because one on planet we can run away. Okay, and also third one is do not invest based on news. I think most of the retail investors miss out the rally is because they are too influenced by all the news, negative news. Every day you open a newspaper, go to the internet, it's all negative news. That you prevent people from investing.
And just today morning, they said they had 2 million deaths from COVID-19 worldwide. Yeah.
I suppose this is what, again, coming back to the reality is you have government support, you have central bank support, and hope with vaccine in the backdrop to lead to a better or healthier 2021. So I suppose this is where we are at this point in time. And even though the macro picture is still somewhat uneven in terms of recovery, obviously some industries are still significantly affected, travel insurance, travel and the related industries, whereas others, technology, I think, is still benefiting from the change in behavior, etc. as well. So it's still going along that line. So as long as we have all these stimulus in place, exchange rate being still stable enough, interest rates still very supportive. There's a lot of anticipation. Interesting environment we still sit in.
What an era we are in.
Indeed.
So Kenny, do you have anything to add?
Yeah, I think the moving forward in the recovery phase, right? Probably the investor can really look at these few sectors, because I have done the research and also currently I'm managing and also advising a client, helping them to build a portfolio. Basically, I have a position already in China equity, because let's think about it. Moving forward 5 years, 10 years down the road, China, you definitely recover, definitely get strong.
Already recovered, so again, this is anchoring Asia and probably a global growth in terms of many industries.
Yeah, the global growth.
So you cannot avoid. Yeah.
China will be the leader, and China will lead the rest of the emerging market. So emerging market has been beaten down last year, right?
Yeah.
I think this year probably come back to life due to the economic expansion. At the same time, I think the currency will be strengthened against the US dollar. Right. Last year, everybody ran away from the emerging market currency. Safe haven. And for the sector-wise, I believe that the technology sector and also financial sector, you continue to do well, right? And of course, under the low interest environment, will be property and the risk sector, you continue to do well moving forward.
Fingers crossed. We just need to get through this current period of. I think the key from the macro standpoint, where doubts continue to come through. The hope and fear themes is essentially playing out. Hope, as Kenny says, in terms of how the recovery is still intact, but obviously the fear remains is whether the current infection. We have seen cases in countries of restriction, lockdown in place, neighboring country. So far that hasn't significantly affected supply disruption too much just yet. So that's still positive. So the question is, do we see a double dip for countries? To what extent the lockdown lead to slowdown economic activity in Q1? So I think from an investor standpoint, we're still in an environment where, now it's still not so exciting. Maybe it could be problematic in countries, but second half, confirm joke better, vaccine rollout, etc. So for Kenny's standpoint is how far ahead do you need to look forward to, whether valuation is too much or we can still find or stick to smaller cap growth stock. Because from a macro standpoint, I think it's very important. We are at the start of a new growth cycle. I mean, every 10 years or so, if we just look at the region, Singapore, for instance, 10 years or so, we get growth cycle. We ended last year on a quite long, mature growth cycle. We were all worried about what could trigger the recession or a downturn. Trade war and the Trump administration was one of the risks. In the end, it turned out to be a little virus. And so we are now starting on a growth cycle, new one, but we don't know how long it will be when we move on to a more sustainable pace. But investors also positioning early is good, but I suppose again is you have to be careful. I mean, listen to Kenny in terms of how you want to position yourself, because it could be an uneven bump, but nonetheless we are on a new growth cycle. It could still start on a very uneven, unsteady pace, but we should still be on a new growth. The worry obviously is the initial stage of this growth could be still somewhat
so it could be a bumpy ride.
It could be a bumpy start to a new growth cycle, but nonetheless, it is a start of a new growth cycle. So that's...
Yeah, to add on what Singhu mentioned on the new growth cycle, maybe I can be more specific, right? Every crisis, you create opportunity, new opportunity.
Yeah.
Now you can see that because of the COVID-19, the whole world is really searching for the solution, the vaccine itself. Yeah. That will really trigger the growth sector in the biomedical, bioscience. And another sector probably will be here to stay and definitely will continue to power the whole global economy is a 5G introduction.
Correct.
Because 5G is here to change the world. And you just imagine that in order to have 5G, all our gadgets, right, that has to be upgraded. That will really help to grow the semiconductor sector, the test assembly, the wafer fab, basically
the modern service, modern manufacturing. Yeah.
Right. And all these kind of manufacturing plant, manufacturing assembly house or the EMS itself, basically they have in the whole Asia Pac region. That's why over the long term wise, as long as investors have the long term investment horizon, I think Asia Pac is still the place to invest.
Confirm.
Double confirm. Confirm and double confirm.
Thank you, for the insights, right? So the next question we have is that Biden is actually the president-elect. He's going to take office, and he recently just rolled out a 1.9 trillion stimulus. Do you have any opinions on that? Or is the stock market is actually already priced in?
Yeah, I think from a market standpoint, it's probably priced. Okay, let's take it from a macro perspective first. It basically just illustrates the point that the U.S. economy is still in a very vulnerable state. Jobless claim pre-crisis, almost misremember, pre-crisis level when we're talking about over a year ago now, had run at about 200,000 weekly pace. It is still 700, 800, 900 at this
close
point.
To a million, yeah.
Close to a million. So again, labor market is still very vulnerable. But yet at the same time, we got the dichotomy. Some industries doing very well, modern services, modern manufacturing, as Kenny pointed out. But yet for the broader economy, labor market is soft. So it needs, as we say, no money, no honey, no honey economy stuck. So in that sense, the fiscal side has to come through. Monetary policy has been doing the heavy lifting, so fiscal policy has to come in to continue the support until we do see broad-based sustained recovery. It's still obviously a long way from that one, so it's needed. So hence the expectation that more spending will be coming, blue wave will be lifting, the economy out of the doldrum, etc., inflation coming through, interest rate coming through, which is why we have seen wobbles in the bond market itself. If it works out in the longer run, jobs are created and spending increase, then in the longer run, new growth cycle is positive. Again, back for Asia, we sell them all the barang that they need. I mean, despite the trade war, US imported more stuff from China last year than ever before. So that will continue, and parts and assembly are in Asia. Will continue to support that.
That is something that we can't run away from, right?
We can't run away. So that supports the earliest thesis we're talking about Asia still being the growth driver.
Actually, basically, I don't care about so much what the economic news, because at the end they are just the noises in the market itself. I don't really bother whether Trump or Biden.
Trader, bagus.
More pragmatic, right?
Yes.
Biden, Trump, it does not matter who is the president, as long as stock market continue to grow up and we are able to leverage on it, tap on it, I think it's good. For example, if you look at the past history, we have the US-China trade war, Trump era, now Biden era, and also Brexit. What does the market do? They do their own thing, right? So for my focus as a trader or investor, it's important to focus on mega trend. Any economic news, political news, they are just noises in the market and cross the volatility. But the volatility, that one can scare a lot of people.
True.
So investor, if you really have a long-term investment horizon, just focus on mega trend, then you'll be safe.
Thank you for the insights. Okay, now let's move on to the next topic, right? We're talking about interest rates. Of course, right now we're in the low interest rate environment. So, I'd like to ask Seng-Moon, from an economist perspective, do you think 2021 is going to be a continuation of this low interest rate environment?
Simple answer, yes. Basically, is as long as we continue that uncertainty over the pace and shape of the recovery, we continue to see the current infection, still impacting consumer business behavior, and importantly, investment behavior. You cannot tighten interest rate because there is very little demand that is supporting inflationary pressure. So until we see sign of, as I say, broad-based recovery, then I think we will essentially see interest rates staying low. Although there has been some expectation the US bond market has reacted to the blue wave a stimulus plan. Perhaps a bit early, because a lot still can happen that politicians in the US, given what has happened, may still not able to agree on how to execute it because they have other issues on hand to worry about. So simple answer is it will stay low for the most part, I would say this year and perhaps into next year. This time next year we'll talk about interest rate.
All right.
Yeah. I think more or less the same. This year, throughout the whole 2021, interest rate very likely, I think more than 90%. If you look at those statistics, still 90% will be stay low at this current level. And I wouldn't be surprised the interest rate can continue to stay low for another 2 or 3 more years until 2023. Because this year, I think that we are still busy fighting the COVID-19.
Correct.
Right? And unlikely the global economy will have a proper recovery when into 2022. Right? Probably we still need a low interest environment to really help the economic recovery. right? So for the investor, if you have excess money in the bank sitting down there idling, you just be prepared for the next 2 or 3 years. You have that kind of very low interest rate.
May not necessarily go down to zero, although many are already, but at least it's from where we are today going up, it's still, it may have, the expectation may be higher, but the reality is we're probably off the low, but no way going to be trending up much higher.
Thank you for the insight. So just to add on, right, I know Kenny, you're a REITs expert. Tell us a little bit more about the what's happening to REITs, and probably we've seen the FTSE Singapore REIT index. Wow, is probably recovering so fast since that dip, right? Can you share a little bit more insights with us?
Yeah, since the market crash in March 2020, actually REIT index itself has already rebounded close to 50%.
Wow,
right?
Yeah.
So actually the best time to invest, unfortunately, sorry for most of the investors out there, the best time to invest was in March to May timeframe period during the rebound period. So I would expect the REIT continue to do well moving forward because of the low interest rate environment and also the global economic recovery. The rentals start to come back, the dividends start to come back, but we wouldn't expect to have such a stellar performance compared to 2020, right? Probably there will be another 10 to 20% upside, go back to the pre-crisis level at the normal rate, and also the dividend start to come back. All these fundamental changes and also recovery will probably attract 2,000 investors come back to the market. So far, I think the investors still sitting on the sideline. One of them is too much cash idling down there because you expect a low interest environment for the 2 to 3 years. Right, investing in REIT will give you between 4 to 8% dividend. Some of them is really no-brainer if you choose the right one. Right. On another hand, is low interest environment also create a super or hyper low yield in the bond space.
Yes.
Right. The bond investor and the bond price is pretty expensive. You know that there's an inverse relationship between the interest rate and also bond price. If the interest rate move up, right, the bond price will come down. That's why I don't think the reward versus risk is really justified for the bond investor to continue to stay with the bond. So I expect this group of bond investors, they maybe allocate some of the portion come to the REIT space or property space.
Makes sense. Thank you, Kenny, for sharing this. Mr. Song, do you have anything to add in relation to that for interest rates?
No, again, it may creep out, but it's only incrementally so. So for now, I think that's the assumption that we are, and most of us are holding on. Obviously, there is risk should that comes out to be different, but I say that's still a very low probability event.
Okay, thank you for sharing. So right now, I think we have about 15 minutes left. So let's move on to the questions that our audiences have, right? So if you have any questions, please put it to the right side on your screen, all right? So I think the very first question is, banks. We can't run away from banks, right? Okay, see, there's this question, from Mr. Anonymous, from the 3 banks, which one do you think will perform better this year and next year?
Wow, like that one. Okay, lay the backdrop first. If things are going to be better in the next 12 new growth cycle, so things, if we are seeing interest rate coming up, but very gradually, if we are seeing demand for money coming back, loans creeping up, claw back from provision, this should be supportive. Again, the question is how far forward you want to look at. If 3 banks, I would say you take turn. You own all 3 banks, you show at one quarter you like one bank, next quarter the analyst says the other bank, but anyway, I digress. I think you should be one.
I think let's talk about macro first. Why the bank, especially Singapore banks, are back to life in November, right? All the way
we were talking about that.
Right. I think that first of all, during the COVID-19 period, actually everyone expect a lot of default, right, of the company. That's why there are a lot of back debt being provisioned in all the banks' balance sheet, right? But after the latest earning coming out and also the reopening of economy, actually the situation is not as bad as what we think. So that can be one of the reasons why that the investors start to put high hope on all the bank sector in Singapore, right? On the other hand, is that if based on the historical value on the price to book and also price to earnings itself, Singapore bank basically they are really undervalued, Okay, not now, unfortunately. All right.
Less so lah.
Yeah, less so. So there is the so-called the rotation. I'm seeing that there's a rotation back to those value pick, undervalued stock, and that's a normal behavior in the stock market. Right. So come back to the three banks. At the present moment, I think DBS itself has already rallied close to 30%. Right. Since November itself. Right. Because DBS is one of the strongest bank in the world.
Yeah.
So it's not surprisingly during the global economy recovery and also the rebound. Normally you lead by those big cap, fundamentally strong balance sheet bank. They'll lead the wave, right? So UOB and also the OCBC are the laggers and probably have offer much higher so-called upside potential moving forward. It's based on the valuation point of view, right? But you never know because there are such a plenty of liquidity in the market. If the big fund manager, they have a huge rotation back to the financial sector, right? And all those big cap, which have a higher weightage in the index itself, they may move even higher.
Thank you for sharing that. Right. So I think the next question is pretty related to that because it's on the SDI ETF. So of course we all know that the three banks and the one telco Singtel is actually dominating the SDI ETF, and as it already ran up to it sort of recovered. But what do you think in the near term, maybe 3 to 6 months for that? Would it continue to recover? Would it be slower, or would it be dipping even? Yeah.
I think SDI now back to 3,000.
Yes,
correct.
On the dot, actually, somewhere.
Somewhere 3,000.
3,004 point something.
Yeah.
I just chatting to a technical analyst, the CGS guys. I say, okay if we cross the 3,000 and we can say above the 3,000, then we look at 3,100. So we move in the 100 range in terms. So at the moment, I would say rising tide has lifted everyone, but again Singapore have been a laggard. I mean, up to remember we were at November, we were among the worst performing market in Asia, I think down like 25% next to Thailand. We crawl back. Last year we still ended up obviously still in negative, so now we are even less negative at this point. So back to the scenario in terms of the mathematics of it is if the banks remain supported, the property developer remains supported, then the overall market can be supported.
Because if you look at the component itself, close to I think 30%, 30%, they are bank sector. Right. I think the REIT about 12%. So the property counter plus the bank sector itself is already 50% weightage of the SDI. So basically the whole SDI, why they are moving up, basically is powered by bank. For the REIT index itself, it has been moving sideways for quite some time. Only recently, I think this month, they start the uptrend again. So the bank sector trend is up, the property sector and REIT sector trend is up. My take is I think the SDI will be better performance this year.
So I'll take the next level would be, let's see if the big cap stock lifting the market has gone up. What about the second and third tier one? Do we see them lifted? So for that, I think it's very individual in terms of
but I've seen it because the REIT itself, the big cap has already moved. Then actually there's a correction on the big cap, right? For those big cap REIT itself, Ascenders, Mapletree, CapitaLand, those group, right? Now I'm seeing the second small and medium REIT start to move out. It makes sense because always the market behave in this way. They always rotation. Start off with the big cap first, always followed by the medium cap and small cap. Always that's the kind of behavior.
Okay, thanks for sharing. So I think another question from the audience is actually I think probably for Kenny because he's asking what about US office REIT stocks like Manulife, Prime REIT and other types of REIT. They're listed in Singapore, of course. What do you think of that?
Based on the past 2 quarter performance, actually US REIT itself, they are not really impacted. If you look at the DPU, you look at the property income they are collecting, it is pretty resilient. But at the present moment, because of again they are a medium cap, they have to move first. Right, so moving forward, as long as the next quarterly earnings come out, is continue to pay the good dividend, sustainable dividend, and instead of growth in dividend, I think eventually the investor will start to realize that, hey, why not I just park some money over there? Because the dividend they are giving about 6 to 8%. Right, it's pretty decent. Right, there are not many Singaporeans giving us that kind of dividend at the present moment. And of course, another thing is the political thing, because the transition between the Trump, you don't know what Trump is going to do, right?
Yeah. He's
Trump
not going to
and
go
Biden.
away in a hurry just yet. We still have to go through the impeachment, and that could be distraction. So still, I think a lot on the political front to watch.
Yeah, yeah. But as long as investors have a long time view, I think it's just a nonce.
Okay, thank you for sharing. Okay, right now let's move on to the next question. I think this question is pretty relevant. This is not what to buy, but actually what sector should investors avoid in 2021?
What?
Yeah, to avoid. Yeah.
I'm pretty bullish.
Yeah, it's difficult. It's a good question to ask, being contrarian, because like everyone, cat and dog is very optimistic, which is why, again, if you ask all strategists, which is also when they come back to Warren Buffett, if everybody is uniformly optimistic, you should be asking this question as well. But at this point, it's difficult to, I don't know, maybe I could say...
I answer, political right answer. It depends on the investor objective. Really depends on objective. If they want to play growth, okay, of course, to look for those growth sector. I try to be positive, not say negative, because what is the point for us to look at what to avoid? Must well we look at what are the thing opportunity out there, right? To make money, right? So I will rephrase that it depends on investor objective. If an investor want to have a capital appreciation, of course, looking at the financial sector, right, technology sector, China, gold miners, that probably give you the capital gain, right? If the investor is really looking for pure dividend play, maybe risk, maybe bond, but bond has to be careful because the investment grade and also all the government treasury bill yield, the yield is pretty low. The return is not really there.
And there's a risk of defaulting.
The risk of defaulting. So it's really depends on the investor objective.
Yeah, true.
All right, thank you for sharing. So I think the next question is probably for Seng Boon, right? So there's this Mr. Anonymous actually asked, what about renewable energy sector? Of course, the question is in Malaysia, but let's talk about something that is global.
Very topical. I think that's certainly in terms of sustainable investment environment. That is, I think, what more and more companies, even us, are doing as well. Very sexy. So obviously, when things are so hot and sexy, you get a flood.
Yeah.
So the only question is, among that flood of interest and startup, etc., how many will actually survive to realize their dream? So this is where the challenge in. He has, I'm quite sure, quite a few companies in that space itself. But yes, I think it is a structural shift. Does that mean that oil and gas is gone forever? No, because daily use, we still need fuel from which we derive chemicals, etc., to make things from. So we shouldn't avoid a traditional the oil and gas sector, although the way they're getting their energy may change, but still there are going to be a lot more focus on sustainable or renewable going forward. The question is who can maximize it in turn and make money out of it.
Right. I think you take some time because everything comes at a cost.
Yeah.
If you want to go for ESG, definitely you have to incur some capex, you have to
solar,
OPEX,
wind.
to upgrade it. So I think it's still a very infant stage at the present moment. But of course, in order to save the world, save our world, I think ESG moving long term, you continue to attract the investor interest. But whether the valuation and also the return versus rate makes sense or not, at the end of the day, it still depends on how the whole thing develops.
Thank you for sharing. So, okay, the next question, right, it's a very specific question towards the oil and offshore and marine sector. But let's tweak it in a way. Do you all see any restructuring or mergers and acquisition happening in this sector, for at least for this year, among the companies?
Let the economists take a question first.
Interesting question. I mean, they themselves have been around for eons, and they're very large, whether you're talking about Total or whether you're talking about ExxonMobil. And they themselves are also taking effort to see invest also in renewable, while they are still looking at ways of how, as I say, head to toe, going on to shampoo, all the stuff are derived from oil and gas. At some point, refinery, whether the refinery are becoming more energy efficient, etc. I think they are large enough to be able to stand alone to reinvest and to survive. Perhaps where we see some of the smaller independent, say driller, etc., that may have to merge, etc. But I would say as far as I can see, the larger global major are strong enough to be able to be independent without the need to combine. Obviously, we can say, oh, we have seen Exxon and Shell, ExxonMobil does so. Can there be more down the future? We never say no, but ultimately, I think it's still here to stay. As far as the large companies.
The way I look at the oil and gas, there are probably two different sectors. For those companies, they're actually offering some of the niche solution, cannot be replaceable, probably they can still survive, right? For those really, they are in the commodity space, they are using the price to really compete for new business. I think the M&A will happen, right? Because at the end of the day, oil and gas industry is really capex intensive, right? You don't have cash flow, you don't have capex, you can't play this game. Especially during this period, the global economic recovery is still in question mark. There are a lot of companies that are actually quite reluctant to really invest in capex, right? To increase the capacity and compete. So if they are not able to invest in capex, how going to survive? Because the margin is eroded, the demand is not there. So
Thank you for sharing. Okay, we have just 5 minutes for one last question, right? So I think this one is about sectors again. So Mr. Anonymous actually asked, which sector can I invest in to actually hedge against growth technology stocks?
Hedge against growth technology stocks.
Yeah, let's say if your portfolio, I'm assuming that he's saying that he has some growth stocks, but he wants to hedge the kind of risk. Would it be REIT or would it be financial services? Or something else?
So far, I see that actually some of the sector is not so highly correlated with those stocks. The bond sector is one of them, right? But bond when the sell-off in the growth sector happening, of course your bond will not go and spike, right? REIT is less volatile and do its own thing. As long as dividend coming back, then it's okay. I think gold can be another option.
I think given what has happened here, it's probably good still to have gold as part of gold portfolio, just a function of how much.
Right. Especially you look at a gold miner, right? Gold miner, the production cost is about $1,000, right? The gold price now is about 1,800. That means gold miner mining company, they are making money. And actually they have a lot of cash, and the gold mining company they pay better dividend than risk at the present moment.
That's true. You may want to consider about alternative as well. To what extent? We haven't talked about crypto.
Maybe you can share a bit of crypto.
We don't know. I mean, Lao Jiao like us, we say, what? They want how to value this thing, yet the prices gone up.
Crazy.
So it will probably still crazy as the only thing I can understand is as long as you continue to sing Bon Jovi's Keep the Faith, it will keep going. But it has sprung up, and to some extent it become more interesting because you have seen some of it moving on to the traditional formal financial sector in terms of exchange being set up. So you have a formal structure over a product which is gaining, I suppose, traction. So there's something to look at too as well. Although at this moment, I say I don't know enough to be able to say.
Yeah, actually, we had to anticipate the sell-off. Right, so it's always good that don't put all the egg into one basket. For example, group stock, you are allocating 100%. Okay, you're asking for trouble.
Correct.
Yes.
Right? Maybe allocate 30%, 40%. I think
that's key message.
That's key message.
Of a portfolio that suits your own risk profile.
Right.
Young or a bit like me, very different risk profile.
Yeah, very different. And because and we are investing in such an uncertain time, we do not know what will hit what.
Correct.
Right. So it's better to really, like what Bruce Lee say, formless. When you pour water into tea pot, you become a teapot.
Yeah.
Right? You pour somewhere, it becomes somewhere. Something that just make it formless, and after that build a diversified portfolio. Whenever anything strike in your portfolio, the whole portfolio is balanced out. I think that's the key message.
Easy to say, but hard to do, but try.
But this is where investors are supposed to know themselves and how to weather the storm as well through effective means of diversification. Right, I think that's one key takeaway from this panel as well. So I think we come to near the end of the panel discussion. So thank you for your time. Thank you for tuning in on a Saturday morning. So we'll have a next session coming up at 11. In just a minute. Go watch it, right? So I'd like to thank two special guests, Mr. Song Seng-Woon and Mr. Kenny Low, for your time on this panel discussion. It was a fruitful one, and hope that everybody had takeaways. All right, thank you.
Okay, thank you.
Thanks.